Okay. So when we're looking at bad debt and receivables, we first talk about extending credit. Why do companies extend credit to people? Does anybody know why we do it? Or what's one of the biggest benefits of extending credit to another company?
Because then they're indebted to you.
What was that?
Because then they're indebted to you.
They're indebted to you. Yeah, no kidding. But what's the only reason why a company really sells to somebody else on credit? What are they trying to do by doing that? Why are they letting them buy on credit? What does it do? Why do stores let us buy?
Interest.
What was that?
It accrues interest.
It accrues interest. And by letting us accrue interest, it increases their sales, right? So the number one reason businesses extend credit, not people to us, because the reason they extend us credit is definitely interest. You're absolutely correct. But the number one reason businesses extend credit to other businesses is to increase revenue. That's the only reason, because that is the number one advantage, when in fact there's actually 3 disadvantages. One disadvantage is bad debt. People don't pay their debt, right? I mean, you obviously need to have a really big positive if people are not going to pay you back. Whereas if you walk in somewhere and they only take cash, you know you're going to get paid. But if you extend credit, now you run the risk of not getting paid. Another disadvantage is what's called the delayed receipt of cash. Meaning, if someone doesn't pay you, you now don't have the money to go do something else. So you are short of the cash that you could have. And then the third is increased wages on your end. When somebody has extended credit, they now have to worry about going out and collecting the money. So you now have to employ people to go do that. When my first job out of college, which we haven't talked much about because of the time frame and everything, but I was the computer department in a small company. I was also the accounts receivable department, which you really shouldn't be both of those, and that's a whole internal controls thing we didn't get to talk about in chapter 5. But so I was the IT and the AR person. Now, I had a boss who was the accounts payable and overall accounting person. So there was 2 of us. We had a VP, we had a couple salespeople, and we had 5 collection people. That was the company. So there was a total of like 10 people, and we had 5 collection people. And what did we do? I don't even want to tell you because that tells you how old I am. But we rented cellular phones. I know, okay? They actually used to be rented out. But we rented cellular phones, and we had 5 people who called on collections. So that is the increase in wage costs. You have to have people that will call and say, you owe us money, and it's not a good job. I recommend you try to do anything else but that job if you're looking for a job. So we have to go and we have to look at how do we account for this? How do we account for this as a business? Because every business is going to have it. Every business is going to have it. And you cannot put accounts receivable on your financial statements and put the whole amount when you know, in fact, you are not going to collect all of it. If you put accounts receivable and do not put an estimate for bad debt, you are overstating your financial statements. So here's what we've been working with so far: accounts receivable and sales. And what we put was we just put it on our balance sheet. What we've been doing until this chapter 8, is we've been overstating our financial statements because we haven't said anything about bad debt. On the income statement, we had revenue. We were overstating our revenue also because we were just saying, hey, look at all of our sales. We're going to collect it all. Neither one of those 2 things are correct. So what we need to do is try to figure out what our debt is, because obviously we don't know debt until over here. But we just recorded things right here. So what we have to do is go out and try to figure out what that is going to be. So we're going to figure that out. It's called estimates. This is the first. We're going to have 3 journal entries in this chapter. This is the first one. This is called the bad debt estimate. All right, bad debt estimate. And it's a straightforward bad debt expense, allowance for doubtful account. This is our second contra asset. Our other one, we haven't used very much yet, but it's allowance, it's accumulated depreciation. We've only used it just a little bit, but that's our other contra asset. That accumulated depreciation goes under equipment. This goes under accounts receivable. And just like accumulated depreciation, you show under equipment, and then it kind of says net equipment, kind of tells you what you think your value is. That's exactly what this does. We think our value of accounts receivable is this. Then over here on the income statement, we have our sales, and then we have our bad debt expense that we're estimating. So we're not overstating our income statement anymore, and we're not overstating our balance sheet. Okay. We do that estimate at the end of the month after our sales, based on our sales amount. We don't really know when bad debt's going to be known, but we have to make a guess, and we do that estimate at the end of the month or period in which we're at. And then there's just a whole bunch of arrows. All right, now, the next one, our journal entry, is what happens if we have another entry in which we receive the bad debt, and now, bad debt at a later date, if you can see here, is what we call written off. All right, that's when we know someone is no longer going to pay us. All right, that's what it means by bad debt is known. So sorry, Adam. Adam is not going to pay us. Adam's told us he's not going to pay us. He is not going to pay us. We are actually writing off his account. So for $200,
pick on me.
I know I have to. Sorry. So we take it out of accounts receivable. So now we're taking it out of this account, and we take it out of allowance for doubtful accounts because we had estimated that was part of it, and we're taking it out of there. So now it's out of there. Before that, it was just an estimate, and we didn't affect accounts receivable. Now we're actually taking it out of accounts receivable. But we don't do that until we know for sure that Adam was not going to pay us. Before that, it was just an estimate. So this journal entry here is the estimate, and this one is the write-off. You do not do the write-off until you know that someone is not going to pay you. All right, so those are the 2 journal entries. Make an end-of-period adjustment for the estimate, and then remove it, write it off once we know that they're not going to pay us. So Vanity Fair is the example that they're giving us here. They estimate they're going to have $900 in bad debt at the end of the accounting period. So the journal entry to record it is a debit to bad debt expense and a credit to allowance for doubtful accounts. All right. And then they just kind of go through and they show us just here's our sales, here's our estimate at the end of that period. And then they're wanting to go ahead and let you see how this would look like in a balance sheet. Notice this right here. This number right here is not this number. This $900 is just being added to allowance for doubtful accounts. I'm going to show you in the next slide. This $900 is going to bad debt expense because bad debt expense is a temporary account, remember? Allowance for doubtful account is a permanent account on the balance sheet. Whoops, sorry. This number is just getting added to that 15,000. So that 15,000 was probably 14,100, and we just added $900 to it. Now Vanity Fairs wrote off $800 because Fashions, I can't talk, could not pay its bill. And now the next shows you how this would affect the accounts. So remember I told you at the beginning, 4 weeks ago, but beginning of the semester, there was only one chapter that I was going to highly recommend you use a T account. That's this chapter. And this, I'm going to show you why, but here's some examples here. So this is accounts receivable. We see that here's the sales. Here's our $900. There's the $1,400 that I mentioned. It upped it to $15,000. Here's our bad debt expense that went to $9,000. And then we wrote off this $800. That write-off goes there and there, giving us an ending balance of $14,200 and $19,200. $199,200, sorry. All right, so that's just a little background on bad debt. Now the heart of it is, how do you determine what is bad debt? So it's great that Vanity Fair was $900, and I'm going to do this. Oops, I went the wrong one. So there, Vanity Fair is $900, but how do we get that $900? There's two ways. Of course, there's an easy and there's a hard, right? That's kind of how we do things. The percentage of sales, and it says credit sales, just a little hint for class. If it says credit sales, great. It doesn't always say the word credit for some reason in your homework. So you can assume that if it doesn't say credit, it is credit. All right, so sometimes a homework problem has that and it gets confusing. So percentage of credit sales is the easiest. All right. But aging of accounts receivable is the most accurate. Percentage of credit sales looks usually at a month, but looks at just that period of sales. All right, month sales, period of sales. So it's looking at a time of sales. And it literally says, take this percent times sales. When you do that, it gives you bad debt expense. That's why it's easy. And then you do that journal entry that I was just talking about, bad debt expense allowed for doubtful accounts. Allowance for doubtful account. Aging of accounts receivable is based on entire accounts receivable. So it's not looking at this month's sales and saying how much of this month's sales are we not going to collect, or how much of this period's sales are we not going to collect. It is looking at all of our accounts receivable. The entire, whatever we have from this month back to however long we have, and how much of that are we not going to collect. And then we break it down to periods like 0 to 30, 31 to 60, 61 to 90, and then usually something like 91 and over. Each of those periods gets some type of percent that's uncollectible. And then you take that percent and you multiply it by the dollar amount in that time frame to get a total amount, and you add that all up. Now I know this might not make that much sense, but we're going to apply it. This number . goes in the bottom of allowance for doubtful accounts. That is the total that we want to be in allowance for doubtful accounts. That is that $15,000 that we saw in allowance for doubtful accounts. We are looking for the grand amount that needs to be in allowance for doubtful accounts. All right, so let's go. Here, we're talking about how much is going to be uncollectible. And it's going to be based on historical percentages. What has it been in the last bit? Honestly, one of the biggest mistakes you guys make here is converting that to a decimal. All right, a lot of times you guys put 0.75% as 0.75. Just make sure you do the right decimal. But in class, typically I'd be asked, well, how do they know what their percentage should be? They're going to look at what last year was, what the year before that was. If they're a brand new business, they're going to look at other companies to see what their uncollectibles were. So 3/4 of 1% is 0.75. All right? No, it's not. Right? You guys are not in a class where you can talk to me so quick, but it's actually 0.0075. 3/4 of 1%. So when we go ahead and multiply that out, that gives us the Vanity Fair 900 that we saw before. And what I mentioned about being easy is that is bad debt expense. We are calculating bad debt expense for 1 month of sales. All right. Does that one seem easy enough? Maybe. Unless I put you guys to sleep already. All right. So here's our aging of accounts receivable. In order to do this, we have to have a couple different things. We have to age the accounts receivable, we have to have the estimates, and then we have to have the total bad debt. So this is kind of a little idea of how it looks like. You'd have all your customers going down one side. You would have totals for all of them broken out, as I had mentioned before. Here's our days. The customers going down on one side. Then we would go ahead and break it out. Now, if you're just looking, one thing you're kind of going to be able to see from something like this is if you look at a customer like Adam Sports, they owe $400, they owe $200, and they owe $100. So what would you think of that type of company? Would they be a company that you would still lend money to? What do you think? Would you lend them money?
I'd say yes, because it looks like they're working to try to pay it.
Exactly. They probably would, because here's the other thing. They just lend them $400 or sold them $400. So they must be doing something. But what about Momentum Close? What about them?
That would be a no.
That would be a no. Exactly. And then Zoom, you'd probably be good with them too. All right. So if you look at everybody all combined, over 165,000 of the 208 is 0 to 60 days. In today's world, 60 days is actually okay, but I don't know how happy they would be with this 43,000 that's still 61 and over. Because look how, and this is pretty realistic, look how this jumps. And that is, like I said, realistic. The more, once you get over that 60 days, it jumps drastically. So what happens then is once you have your totals, you multiply by the percentages. All right, so we multiplied and then we got a grand total. That is the number that we want to be our balance. So that's our added step. Unlike percentage of sales, where once we did our multiplying, that was bad debt. We are looking at the entire accounts receivable. So we are looking at we're looking at the desired balance. We're always going to be given this number. That's usually called the unadjusted credit balance. All right. So we were given 14.2, which means 1,300 is going to be our bad debt expense. And that will be what the journal entry is. We need to increase allowance for doubtful account by $1,300 so that we can get to the balance we want. So if we go ahead and move on, that's what they tell us. And then we would do the journal entry for bad debt in order to get us where we want. Now, one of the things they talk about is, yes, we do revisions. Revisions happen, write-offs happen, and another thing that also happens, sometimes you recover from people. Adam decides to pay us back after he told us he wouldn't pay us back. What do? You have to do what's called a reversal. That's the third journal entry. You actually have to go in and put the money back into Adam's account. That's the accounts receivable. You put it back into allowance for doubtful accounts. Then you collect the cash and take it out of Adam's account. The reason you have to put it back into Adam's account is because you have to be able to go in and reestablish his credit so that you can show that he's paying off his account. And then you record it. Okay, so let's go to your working papers. Sure, where's everybody's at? Let's take a look at this problem. So it talks about that this company has two ages of categories. Young ones that are 5% uncollectible, and then it has older ones that they consider to be 40% uncollectible. So in the first one, it says Young has $100,000 in accounts that are considered to be young. So we would look at those as being, make that go away, 5% uncollectible. And then we have $400,000 that would be considered old. Which would give us $165,000. And it says, how much should be reported in allowance for doubtful accounts? So is that my answer for allowance for doubtful accounts?
It was my answer, so.
That is the right answer. Yes, so that's an answer for what we want in allowance for doubtful accounts. So now the next one says, allowance for doubtful accounts has an unadjusted trial credit balance of $40,000. How much should we credit the account? Well, we just said we want it to be $165,000. If it has an unadjusted balance of $40,000, then we want the credit to be $125,000. And that would be that estimate journal entry of bad debt expense and allowance for doubtful accounts of $125,000. Did we get that? Mm-hmm. All right. I feel like I got two. Huh? You're still writing it down? Okay. Now the third one says, what if we had an unadjusted balance of $5,000? We still want $165,000. what are we going to do to allowance for doubtful accounts? Did we read that one right?
I didn't.
You
So
didn't?
would it be 170?
It would be 170, yes. You read it wrong and you still got it right. And then the journal entry would still be exactly the same. Bad debt expense, 170, because basically we had too much in there. So now we get to, we have to pull it back over this way. And allowance for doubtful accounts, 170. So I know that one took us a while. Did we make it harder than it had to be? Or did it just take us a while to figure it out? Or did we all
Took
just
a little while to figure it out.
took a while to figure it out? Okay. All right, do we have it? Or do you need a second?